All right, today we're going to talk about how to buy an option. I want to make this super simple, super easy. Don't want to waste your time. I wanted to explain what an option is, how to buy it, how you make money by buying it, and in my opinion, the safest way to find the right kind of option to buy if you want to actually trade and make money actively, kind of as a side hustle to your main income. I also want to have a disclaimer: not your life coach, don't not a psychic, don't not a financial advisor. This is all my opinion, so don't sue me. All right, so first things first, what is a call option? So I think the easiest way to explain this is kind of get a visual. Okay, so let's just say $1 is one share equals one share. So an option is always going to be a fixed number of 100 shares. Okay, so one option equals 100 shares. Okay, one option equals 100 shares. All right, so I'm going to use this penguin as an eraser here. So why would you want to buy options instead of shares? Okay, so let me explain. So say you only have $100 to your name. Okay, $100 is all you can come up with. This is what you have to invest, and that's okay. Everybody starts somewhere, right? Well, let's just say you have $100 and you want to buy this stock that's $1 a share. So since you have $100, you could buy 100 shares, right? So cool, you have 100 shares. Now let's just say you do that. You buy 100 shares for $1, right? And let's just say the stock doubles. And you picked the great stock. It just had a humongous earnings report. They just came out with a new fidget spinner and everybody's buying. So now that stock is a couple months later, $2 per share. Okay? $2 per share. Now, you doubled your money, right? So now you have $200 in just a few months. You're happy, right? It's a great return. So now let's just say you spent that $100 on a few call option contracts instead of buying the 100 shares. So maybe let's put it in perspective here. So you have $100. Say it costs you $20 per option contract. Okay. So say you were able to buy, let's say 5 contracts, right? So you had $100 divided by 5 equals, $20. So now you have 5 contracts, 5 option contracts worth $100. Okay? Now let's say the stock does the same thing. The stock hits $2 a share. New fidget spinner's doing great. And you have the option to buy 500 shares because you had 5 options. Okay. So now, even though you only paid $20 for those options, remember the people are going to double their money, right? Because they pay $20. You pay $20, you can now buy those shares. So they can instantly sell them for $2 and double their money. So now those options contracts that you bought for $20, those are now worth $80 per option contract. Okay? So $80 per option contract compared to if you had bought just the regular stock, at that point you'd only have doubled your money. Now you take $80, right? Because that's what they're worth now, times 5. That equals $400. Okay? So do you think $400, you doubled your return compared to buying the actual stock? That is what I wanted to show you is, you can spend the same amount of money on an option contract as you would buying the actual shares, but you can make double and sometimes triple or quadruple the return by buying the options and leveraging your money. The most simple way to look at this is kind of like buying a house. When you go to buy a house, maybe you're a first time home buyer, you want to put down as little money as possible to buy that property. And when you do that, you're leveraging two, 300, whatever house price it is. Say you buy $300,000 house, you're going to put down like $12,000 and you're leveraging a $300,000 house. And then when that house goes up in value, say that house goes up, 3, 4, 5, 6%, you're making tens of thousands of dollars, on that home that you bought, but you only had to put down 12. It's essentially the same thing as options. You basically put down a percentage of the money, right? But you can control the option to buy hundreds or thousands of shares depending on how many options you buy. And this is why I think options is one of the best side hustles. Or honestly, one day I'd love to just quit my job and just trade options. It'd be the best thing ever, in my opinion, because you can make unlimited money. The sky's the limit. And as long as you buy them smart, in my opinion, it's hard to lose. All right, so now we're in Robinhood. We're going to go ahead and check out some options contracts. So let's look at something maybe like Disney. Okay, so Disney right now, it's the stock's at $111. We're going to go ahead and click trade options. Now, if you look at the screen here, you'll see the price will go up, which is the call option. The price will go down, which is the put option. And then you can also kind of do some strategies where you may go up or down, or maybe it stays the same. So there's some other ways you can buy basically two options at the same time, and it basically you can make money that way. But we're gonna keep it simple, just the up and down. Okay, so we don't want to get too far in the weeds. But we're gonna go to January 3rd. That's the first options available. Now, at the very top here, you can see buy, sell, and you can see call, put. So we're going to look at the call options first, okay? So right now, the share price is $111.31. So you could buy the right to buy this stock at $111, and it's going to cost you, it says $1.03. That actually is $100. So they make it shorter so it's easier to understand. But if you click $103.03. So it kind of abbreviates it and makes it a little bit easier to understand when you're looking at it. So when you see the $1, just know it's $100. Again, January 3rd, $111 call. It's $103. Now the $112 call is $58. And you can look at the last trade. The last trade was $63 someone paid, okay, for one of those options. And if you go higher, $113 call, that's only looks like the last trade was $30, I mean. So this is something that if you really believe that Disney was going to go up real quick, you could actually buy $113 call for $30 each. So say you spent, let's say you bought 3 of them for $90, okay, for the $113 call. And then guess what? Tomorrow the market opens, Disney shoots up into, let's say it shoots up to $115. The easiest way to do the math and see where it comes down to, what you would have made on that, if you had made that bet, is let's go down on a couple dollars. So if it's $4 to get to 115 and you're at 113 calls, so let's go down to 12 and then 11 and then 110 and then 109. Okay, so that's $4, right? 9, 10, 11, 12, 13. So 109 calls equals a 113 price. So if it shot up that $4, your call option would more than likely be worth right around $265 per contract. Now, that's what I think is so cool about this thing is you can basically, if you play it right, you look at the charts, you look at the volume, and I'll go into more details about that stuff later, but you can have some massive returns very quickly, just a little bit of money invested, but you can get some massive returns. Imagine that. Tomorrow morning you put in $90, By the end of the day, Disney shoots up $4, and now that $90 is now worth. You have 3 contracts, so it's like 265 times 3 minus your $90 for what you paid, a $700 profit, just like that. I think that is such a cool thing that you can do just from your house. You can use your phone. Everybody has a smartphone, and you can make some crazy returns. There's even even crazier returns when you go into the larger ones. So say you go into let's look at the SPY. You can actually trade options on this. Imagine you do a January 3rd option on the SPY. It's 587, and these are kind of, a lot of people make a lot of money trading this because the index, the SPY index, it moves $20, $30, $40 at a time, sometimes even more. So you can just imagine, you say you spend $1,000 on some of these call options. See, it's 586. You buy some 586 calls, and then it shoots up $30. I mean, you go do the math on $30 down. I mean, you can get almost $2,000 per contract, and you only put in $1,000. So you're making $6,000-$7,000 on a $1,000 risk if it does shoot up that day. Okay, which you can see like 590. By the end of the day, 580. So it's more or less probably a $15 gap. But again, you're still making a huge return for a small amount of capital risk. Now, the way I do it, which again, I'm trying to make this as simple to understand as possible, I like to do less risky options plays. So I'm going to go back to Disney. Now, let's trade options. Okay, so again, we're going to hit trade options. And instead of January 3rd, I think we should go out. Let's go look at it a little further. So I like to do this. Let's go down, look at the analysts. 33 analysts say buy. That's a good sign, right? Let's go down. Fair value based on book. Robinhood Gold Research says 125. So according to Robinhood Gold Research, we're a little undervalued as well. Let's look at the earnings reports. So it looks like they've done pretty well on earnings. They've beat earnings the last four earnings reports. And then looks like Q1 2025, it looks like they're expecting a pretty good return. It's expected on February 5th. So a lot of times stocks, because the people like to trade earnings, the stock can climb pretty well, climb pretty good either before the earnings or sometimes right after the earnings. So to me, a safe bet to make sure we're making a good decision here is to kind of go off and let's do something in either, I'd say, late February or possibly March. Okay, March is even safer. So let's go into March, and then the stock's 111. So I like to buy where we're already in the green. So I like one that's maybe even a little on sale. So this one looks like its break even is $113. So basically, this is saying that as soon as the stock hits $113, the premium that I paid for this option, the $1,300 I paid for it, is basically, it's already going to be at value. Like that's the break even cost. Like if it goes up to that, I can execute this contract and I'm good to go. I'm fully positive, or I'm fully even. I'm not going to lose any money. So, and you can kind of look down here at the break even cost and kind of see the more expensive the option, the closer the break even cost is, right? So here, the stock only has to move here we go, this one on the bottom here, 0.60, or here, this one's probably even better here, 0.26%, and then you're basically even for that $6,100. But you're basically buying the right to buy 100 shares of Disney at $50 a share. Okay, so you're already very, very much in the green. The most you're going to lose on this option would probably be a couple $1,000s at best, I would imagine. Okay, because they're basically saying you'll buy it at $50. The share price right now is at $111. Okay, so extremely, extremely low risk to buy that. Now, in my opinion, the sweet spot, because for one, not many people have just $5,000, $6,000, $7,000 just sitting there ready to go. And I also want to be able to buy enough contracts where it actually makes a difference. So to me, I think that the stock's going to move pretty well. And I want to be able to buy a decent amount of contracts. So I think that being able to get to $114, $115 is pretty likely. And plus, this one's already down a little bit based on today, the last trading day. So I actually like this stock option right here. So the last trade was for $13.50. So it looks like someone was able to do it for $13.50. The bid when it closed, the highest someone was trying to pay was $13.65. They were trying to get some in before the market closed. And the lowest ask was $1,415. Looks like 20 people or so were trying to get rid of some contracts at that price. So we're going to go ahead and hit, say we want to get this in, buy this at market open tomorrow. We can hit buy. Let's say we have, we want to buy 5 of them. It's at $13.90 is kind of the price in the middle. I want to try to see if I can get in at that other price that sold. So we're going to do the $13.50. So $67.50 is the price. We're going to hit review, and then we can hit there and submit if we have, this is the trade we want to do. So to me, this is a very safe bet that you're going to be in the green. It's pretty good on this trade because of the time. It's going to be right before earnings. If it climbs up, or after earnings, if it goes up. In the end, worst case scenario, again, you're buying the option to buy them at $100. So unless the stock goes below $100, which is, in my opinion, very unlikely based on the current trajectory of the business, you're going to be in the green, I feel. Or worst case scenario, you lose 10-20%. Okay. Now, if you hold on, if it goes down a lot and you keep on holding, obviously, if it gets past March 21st, then you lose everything. The way options work is they have that expiration date. So if it hits March 21st and you're still holding that option, you have to either execute that option and buy the shares for $100 per share, or you have to sell that right away before it expires. Or if it expires, you don't do anything, it's going to expire worthless, and your $66,750 expires. It's gone. It's like that South Park episode when he walks in and says, it's gone. That's exactly what's going to happen, okay? So don't do that. Now, one last option strategy I want to show you, besides going farther out past the earnings, I also think you can buy really safe options, something like this, where it says January 15th, 2027. So you can buy options 2 years out. I think that's pretty incredible. And you can scroll down. Again, I like to buy something where it makes sense. So right here, you can buy a $45 call option. Break even is $115. So again, if you feel this stock is going to consistently grow, they're doing well, they're opening new parks, money is coming in, everything's great, then this is an extremely safe bet. You are paying, what is this here? So you want to buy one, you're looking at $7,000 per contract, 10 contracts for $70,000. If this stock goes up into the, say, 150 range, I mean, you're looking at tens of thousands of dollars in return, versus if you just buy the shares, say you bought $111 times, what would that be, 1,000 shares? That's $111,000 versus you're spending $70,000 to leverage. So you're saving $41,000 that you could invest somewhere else by buying the option instead of buying the actual shares themselves. Well, that's what I want to show you, is leveraging your money. You don't have to spend as much. You can make higher returns, and you can do it safely. I mean, think about that, 2 years for the stock to do what you want it to do. So I hope you learned something today. Please like and subscribe. This is something that one day I would love to do as my full-time gig. Make content, help families, make more money, achieve financial freedom, get out of the rat race. So like and subscribe, leave a comment, share, all that stuff. I truly appreciate it, and I'll see you in the next video.